Welcome to The Explainer. Today we're taking a real deep dive into one of the absolute most powerful wealth-building tools ever created for ordinary people. I'm talking about the S&P 500. We're going to cut through all that noise, skip the confusing financial jargon, and focus entirely on giving you a highly practical, step-by-step guide for building a rock-solid long-term portfolio. So whether you're just starting out or you're looking to really solidify your foundation, you're definitely in the right place.
Okay, let's dive right into this. You've probably heard this exact piece of advice 100 times, right? From Reddit threads, from your financially savvy friends, literally from everyone on the internet. Just put it in the S&P 500. It sounds so simple. And look, while it is excellent advice, it's also dangerously oversimplified if you don't actually know what happens next.
Because here's the shocking reality that almost nobody mentions right after giving you that advice. The S&P 500 has dropped by 50% twice in just the last 25 years alone. And in one of those crashes, it took over a decade to fully recover. Now, does that mean you shouldn't invest? Absolutely not, but blindly investing in something you don't fully understand, well, that's exactly how people end up panic selling at the worst possible time and locking in permanent losses.
So, here's our roadmap for today. First, we'll uncover the truth about market crashes. Second, we'll look at what you're actually buying. Third, a step-by-step investment guide. And fourth, building a 3-fund portfolio.
Section 1. The truth about market crashes. So here's exactly why everyone loves this index. Since 1957, the S&P 500 has returned an average of roughly 10.5% per year. That's assuming you reinvest your dividends, of course. Let's make that real for a second. If you had taken 10 grand back in 1990 and simply left it alone, I'm talking no stock picking, no trying to time the market, zero genius financial strategies, you'd have over $200,000 today. It's wild. That's the absolute magic of compound growth, and it's exactly why legendary investors like Warren Buffett say a low-cost S&P 500 index fund is hands down the single best investment most people can make.
But averages hide a lot of turbulence. That 10.5% return, yeah, it's definitely not a smooth line going up and to the right. In the year 2000, the market plummeted 49%. And get this, it took a grueling 13 years to fully recover. In 2008, it dropped 57%, taking about 5 years to bounce back. Even in 2020, it dropped 34% in just 33 days, though, that recovery was unusually fast. The point I'm making here is, if you had invested your life savings right before the year 2000 crash, and then needed that cash 5 years later, you would have been forced to sell at a massive, agonizing loss.
Which brings us to the absolute most critical rule of this entire explainer. The S&P 500 is an extraordinary long-term investment, but it is not a safe short-term one. The market literally does not care about your personal timeline. If you're going to need your money within the next 3 to 5 years, say for a house down payment, a wedding, or an emergency fund, it does not belong in the stock market. Full stop. No exceptions. Short-term money belongs in a high-yield savings account where it can earn a safe 4 to 5%. Only the money you can leave completely untouched for 5 years or more has any business being in the market.
Section 2. What you are actually buying.
So what actually is the S&P 500? Well, it's not a company, and it's definitely not a single stock. It's an index. Specifically, it's a highly curated list of 500 of the largest publicly traded companies in the United States, weighted by their market value. So when you buy an S&P 500 index fund, you're buying a tiny, fractional slice of all 500 of those massive companies in just one single transaction. That gives you instant, automatic diversification. If one company struggles or even goes totally bankrupt, the other 499 are right there to carry the weight. Basically, when the American economy grows, your money grows right along with it.
Now, what's really interesting about this is the hidden concentration risk that beginners almost never hear about. While it's pitched as 500 broadly diversified companies, the top 10 mega-cap tech giants, we're talking Apple, Microsoft, Amazon, Nvidia, Google, they now make up over 35% of the entire index. Apple alone is roughly 7%. Microsoft is right behind it at around 6%. So what does this mean for you? It means your investment is heavily concentrated in a very small group of tech companies. If those giants face a tough decade because of new regulations or fierce competition, the whole index suffers way more than the number 500 implies. It's absolutely vital to understand this reality before you buy in.
Section 3. Step-by-step investment guide.
All right, here we go. There are 4 distinct, non-negotiable steps to actually putting the strategy into practice. We've got to choose the right fund, use a tax-advantaged account, dollar cost average, and, perhaps most importantly, not look at it constantly. Let's break these down.
Step 1. Choose the right fund. Listen, actively managed funds will charge you 1 to 2% a year just for the sheer privilege of underperforming the market. We don't want that. We want low-cost index funds. SPY is the oldest, but honestly, its expense ratio is a little high. VOO from Vanguard and IVV from iShares, those are excellent gold standards with a tiny 0.03% fee. But look at Fidelity's FXAIX. It boasts the absolute lowest fee available at just 0.015%, and there's literally zero minimum investment. You could start with $1 if you wanted to. The difference between picking one of these specific low-cost funds is pretty negligible, but the difference between buying one of them versus doing nothing at all, well, that's life-changing.
Step 2. Use a tax-advantaged account. So the crucial point here is that where you hold this fund dramatically dictates how much of your own money you actually get to keep. If you just use a regular, standard taxable brokerage account, every time dividends are paid out or you sell some shares, taxes quietly eat away 15 to 25% of your returns over time. It's a huge drag. But if you use something like a Roth IRA or a 401k, your investments grow completely tax-free. And with a Roth, when you withdraw in retirement, you pay literally zero taxes on those massive gains. To put that into perspective, for a portfolio growing from $50,000 to $500,000, using a Roth IRA can save you over $100,000 in taxes. No joke.
Because taxes are such a massive, silent wealth killer, you've got to follow a really strict order of operations for your money. First up, contribute to your workplace 401k exactly up to the employer match. That is literally free money, folks. Always take it. Second, open up a Roth IRA and do your best to max it out, which is $7,000 a year in 2026. Third, if you've still got money to invest after that, loop back to your 401k and max that out. Only after you've exhausted all of those options should you put anything into a standard taxable brokerage account. If you ignore this specific order, you are unnecessarily and voluntarily donating your hard-earned future wealth right back to the government.
Step 3 is dollar cost averaging. Now this sounds fancy, but it simply means investing a fixed amount of money on a set schedule, like every single month regardless of what the stock market is doing. You don't try to wait for the bottom, and you definitely don't stop when things look bleak. You just automate your purchase. And here is the mathematical magic of it all. When the market drops, your fixed contribution automatically buys more shares at a steep discount. When it rises, you buy fewer shares. Over time, this constantly averages down your overall cost and brilliantly removes the single most destructive force in investing, your own emotional decision-making.
And step 4, please don't look at it constantly. Studies consistently show that investors who check their accounts every single day react to all that short-term noise and are far, far more likely to panic sell. Check your portfolio quarterly, at most. Review your overall financial plan just once a year. And when a market crash inevitably happens, do absolutely nothing. Seriously, sit on your hands. Selling after a major drop locks in your loss and guarantees that you are going to miss the recovery.
Section 4. Build in a 3-fund portfolio. Now, to truly diversify beyond just those 500 largest U.S. companies, you only really need a few distinct tools. First, a fund like VTI gives you the entire U.S. market, adding in thousands of mid- and small-sized companies. Second, something like VXUS or VEA captures the international markets, both developed and emerging. This covers the 40% of the global economy that exists totally outside the U.S. And third, a fund like SCHD provides fantastic exposure to high-quality dividend-paying companies. This brings lower volatility and a growing income stream to your portfolio's foundation.
And this brilliantly illustrates how these pieces fit together into the ultimate low-maintenance strategy. We call it the simple 3-fund portfolio. You allocate roughly 60 to 70% to your core U.S. market growth, 20 to 30% to international diversification, and the final 10 to 20% to dividend income and stability. Once a year, you just log in, check your balances, and rebalance everything back to these target percentages. That's it. That is a complete, world-class investment strategy that you can entirely manage yourself.
So as we wrap things up today, I really want to leave you with a bit of a reality check. The S&P 500 is not magic, and it is absolutely not risk-free. It will drop by 30 or even 50% at some point while you're invested. History pretty much guarantees it. We just don't know the exact timing. But history also guarantees something else. Every single investor who held tight through every crash in the past 65 years, the ones who didn't panic, who didn't try to outsmart the timeline and just stayed the course, they all came out substantially wealthier on the other side. Which brings us to the absolute golden rule of building wealth. The investors who built serious, multi-generational wealth were not the ones glued to their screens trying to react the fastest to every breaking news headline.
No, they were the ones who reacted least. Always remember, patience consistently outperforms panic.
We've covered the harsh reality of market drops, the inner mechanics of index funds, the exact steps to automate your investments, and the blueprint for a bulletproof three-fund portfolio. You now have the map. So the only question left is this: are you ready to actually map out your simple portfolio today? And more importantly, do you have the discipline to commit to doing absolutely nothing when the next inevitable market drop arrives? Really think about that. I'll catch you in the next explainer.